welcome to Money Med School, where doctors come to learn about money. Today, I'm going to be talking about the Doximity IPO. Now, you may have gotten an email that welcomed you to participate in something called Reserved Shares Program. If you didn't get an email, then you won't have any idea what I'm talking about. But if you did, then you'll know what I'm talking about. So you might be wondering, what the fuck is this? Should I invest in this? Is this a scam? What is this? What's Doximity? So let's dive in and answer some of these questions. So Doximity is an app. It's been referred to as the LinkedIn for doctors. They offer not only social networking options, but you can share your research with colleagues. You can also answer questions that colleagues pose. And they also offer tech solutions like the caller ID, or they hide your caller ID, and that way you can call patients from your cell phone. And they also offer some telemedicine options, which are really nice. Like you just click, when you want to contact your patient, you just send them a little text link. They click on a link in their text message, and it's so easy for them to join your telemedicine call. So they offer a combination of tech options for doctors as well as social networking. I first heard of Doximity as a fellow when some of my colleagues, actually my attendings, were asked to sign up through Doximity for the university's website. The university was doing something where they wanted the doctors to participate, so they had them sign up for it. I didn't really know what it was. I occasionally get emails from them, never really registered until I heard about their caller ID masking device, because a lot of times I do need to call patients from my cell phone and I don't want my number to be exposed. So this was great. I use it for that, and I also used it for the video conferencing options for telemedicine. Also really great. Now, here's the thing. As with all social networking and free apps and free anything really, you gotta ask yourself, why is this free? And if the content is free, usually that's because you're the content. So keep that in mind as we progress. Now, let's talk about what an IPO is. And before I talk about what an IPO is, I need to talk about what a stock is. So let's break it down. And I break it down to what the fuck is a stock, because I believe in teaching from the ground up, and I don't necessarily expect anyone to know what a stock is. I think we hear stocks all the time. We hear stock exchange, we hear Dow Jones, we hear NASDAQ, but we may not really know what that means. So let's talk about what a stock is. A stock is a little slice of a company pie. So if a company is a big pie, the stock is a little piece of that. And when you purchase a stock, you own a piece of the company, as well as dibs on its future earnings. So you are investing in the company because you think it will do well. If you are investing long term, then you're going to buy and hold. You're going to buy that stock and you're going to hold it for a number of years with the anticipation that the price will rise over time. And that's what happens with good companies like Amazon and Apple and Microsoft. All of their stocks, were initially sold $20, something like that. And over time they rose. And now Amazon stock is worth over $3,000 a share. Apple is over 100, it's like $120, $130 a share, etc. So the idea is that you buy a slice of this pie and it increases in value over time. You can sell it when it increases in value, or you can hold on to it and borrow against it. A little bit of a wiser move, and we'll talk about that in future videos. So anywho, that's a stock. Where do you buy stocks? You buy them at the stock store, which is essentially a stock exchange. In the United States, the two biggest ones are the New York Stock Exchange and the NASDAQ. NYSE is the biggest one in the world, moving like over, probably at this point, $25 trillion worth of financial assets. So it's a big one. So a stock is a piece of the company pie, and you buy and sell stocks at the stock exchange, exchanging, buying, selling, also known as the stock store. And so that brings me to what is an IPO. An IPO is when a company first offers stock for sale. IPO stands for Initial Public Offering. So an initial public offering is the first time that they're offering their stock for sale. Why would they offer their stock for sale? Well, that's how a company can raise money. There's two ways for them to raise money. Take out a loan, go into debt, or sell stock. So a lot of companies will do that. They've never sold public stock before. That means they're a private company. And once they start selling on any kind of public exchange, like the New York Stock Exchange or the NASDAQ, they're considered a publicly traded company. When the stock is initially offered, a price is set. So what happens is the company has to submit a prospectus to the SEC, which is the Securities and Exchange Commission. The SEC gets this document. It's almost 200 pages long, and it has every bit of the company's financial information on it. It is ultimate money nerd gossip, let me tell you. Most people won't read this because they think it's boring, but it is fascinating. Okay, maybe I'm just like a big money nerd, but I'm telling you, it's got everybody's salaries, who gets what stock, how much money the company made, how much money they lost, whether the company is being sued or has been sued. And just like an informed consent, it goes over a list of all of the possible foreseeable disasters that the company predicts could happen for themselves. So in this case, I mean, I think it's, it's illuminating. In this case, Doximity goes over all of the risks that they foresee, and I'm going to talk about some of those because whenever you invest, you should always read the prospectus. The prospectus will either be something like this, or it'll be for real estate investment. There will be something similar, but you should always read that. It goes over all the financials, all the potential risks. Now, the company submits this document, this prospectus, to the SEC. The SEC reviews it, and then at some point, the stock goes on the market. Now, before that happens, the market makers, who are the people who set prices for the stock market, they're going to look at this as this prospectus, and they're going to come up with a value of this company's stock, and they will set the price. Now, there's two prices. One is the IPO price. The IPO price is what the market makers say, this is what it's going to sell for. And the IPO price is what's offered in this pre-sale, which is this reserved share program, and that's what they're offering to us in this email. So that's your pre-sale price. Then there's the price that the stock debuts at when it goes on sale to the general public. And what happens in between those two times is that there can be hype generated between the time the IPO price is set and between the time the stock begins trading on the stock market. That price can go up. So in theory, if you are given the opportunity to buy at the IPO price, you'll most likely have a profit. Now, stocks are a total crapshoot, right? What are you going to do? Could go up, could go down, nobody knows. Nobody knows, not the market makers, like literally nobody knows what's going to happen in the stock market. However, if you're a trader, you have a lot of information that you take in and you make informed guesses. However, an IPO is a stock that's never been traded before. It has no track record in the stock markets. You have no idea how to base your guesses and predictions on what this thing's going to do. And for an investor, most likely it'll probably pay off because you're going to get it at a discount. That IPO price is probably going to be a discount. Again, you have no idea. Let me give you a little example. The Airbnb stock. Airbnb went public in December of 2020. The IPO price was $68 a share. By the time it debuted on the stock market and began selling, the share price was $146. So right off the bat, if you had bought at the IPO price, you could have dumped all of your stock as soon as it started selling and you would have made $78 a share, which is a great profit. And that can happen with tech stocks, and a lot of these stocks are very hyped. There was a lot of hype with Airbnb because everybody knows Airbnb, so there was a lot of expectation there. Doximity is a smaller company. It's a niche. It applies to doctors and pharmaceutical companies and healthcare corporations. I don't know that there's going to be that much hype, but that being said, there could be some. There's probably going to be a gap in the IPO price versus the initial trading price. If you had invested in the Airbnb IPO price, you would have been great this whole time, actually, because even with the fluctuations in price of Airbnb, it never went below $68 a share. Now, if you had bought at the $146 share price, there would have been times you would have lost money. And as of a couple days ago, you would have been up about $3. So there's a benefit sometimes to getting in on the IPO price. What does it mean for us? Well, our investment, as the doctors who are being offered this opportunity, our investment is limited to $5,000. How many shares will that buy you? I don't know yet because the market makers have not set the share price. So, I don't know. But for example, if the share price was $25, you could buy 200 shares. If it jumped up to $50 a share when it opened, which is a 100% increase, which could happen, maybe not as likely with this one, but it's definitely happened with a lot of recent tech IPOs, then you would have made $5,000, which is great. But is it a shit ton of money? No. But is it good money? Yes. You had to risk $5,000 to make it. So it kind of depends on your situation. If you can afford to lose $5,000, then making $5,000 isn't really going to be that earth-shattering for you. If you can't afford to lose $5,000, don't be investing $5,000 in an IPO which has no track record. Write that down. You've heard it here first. Anyway, yeah. So it's not a huge amount of money to some people, and it's a big amount of money to other people. If it's not a huge amount of money, it's not that exciting of an investment, but it might be something nice to watch. If it is a huge amount of money, this is not the investment for you. Okay, that brings me to the prospectus. So I'm going to pull that up here. Like I said, the prospectus goes over the risks and benefits, well, the risks, maybe some benefits, of investing, just like an informed consent. And just like an informed consent, after you read all these risks, you're going to be like, I don't want anything to do with that mess. Let's go to risk factors. All right. So right off the bat, we have a limited operating history, which makes it difficult to evaluate our current business and future prospects. Well, no shit, Sherlock. Pretty much all IPOs have that same issue. Now, they talk about if they fail to maintain their current membership level, that could be a problem. And that's a big problem because they're a social media company. So if doctors stop participating on their platform, then no one's going to pay them to market to doctors. So maybe I should just back up a second here. There's a distinction between their members and their customers. Members, Doximity members, are us, the physicians. We're the content. We sign up, we participate, we use the platform, we exist on the platform. The customers are pharmaceutical companies, healthcare corporations, and recruiters who want to market to physicians. So if for some reason physicians choose not to participate in the platform and we're like, then they're not going to have anybody to sell this to, because they're not going to have no one's going to pay to market to nobody. So that's a problem. And then they are reliant on a small number of customers, so they need to increase the number of customers that they have, these pharmaceutical companies, these hospital corporations, etc. And personally, I think there's a huge conundrum here, because physicians don't always have the healthiest relationship with pharmaceutical companies and healthcare corporations. In fact, these two groups have often been at odds with us and have been responsible for a fair amount of moral injury towards physicians. And even pharmaceutical companies, not just physicians, but patients as well. Not all of them, but some of them. So these relationships are pretty complex and they're not stable. So that's another thing to keep in mind. Doximity's customers are potentially at odds with their members, and the members are providing all of the content for the platform. Without the members, Doximity can't exist. But without the customers, they're not going to get paid. So who do they answer to? Just saying. If they have any problems with reputation and brand recognition, operations will be harmed. It literally states, putting our members first may adversely impact our financial results. Our physicians first philosophy may mean we make decisions based on the best interests of our members, which we believe is essential to our success in increasing our member growth rate and engagement, creating value for our members, and in serving the best interests of the company and our stockholders. So, therefore, in the past we have foregone and may in the future forego certain expansion or revenue opportunities that we do not believe are in the best interests of our members, even if our decision negatively impacts our operating results. In addition, our philosophy of putting our members first may cause disagreements or negatively impact our relationship with our existing or prospective customers. Our decisions may not result in the benefits that we expect, in which case our member engagement, business, and operating results could be harmed. So they kind of admit it themselves. The telehealth market is immature and volatile, could go up, could go down. They state that they're very dependent on the talent that they recruit, which I think any company is. So there's that. Oh, they say they could get sued. They've been sued in the past, so they're not currently being sued now, but could happen. And they don't always know what it could be about. So their insurance may or may not cover any kind of lawsuit, depending on what they get sued for. And then there's just some standard stuff about, we may not be able to execute the plans that we have put forth. We may acquire companies and it may not go well. We may put out a lot of money for that and it may not go well. And our growth depends in part on the success of our strategic relationships with third parties. They're also completely dependent on the fact that their app is available through Apple and the Google Android, whatever that is. Intellectual property risks, risks to trade secrets, etc. Risks related to the healthcare industry, which could be unpredictable. And then they talk about risks of owning stock in general, which we can go over in another video. Essentially, the risk is that you cannot always predict what it's going to do. You anticipate that the price will go up, but you have no guarantee that that will happen. It goes into all of the financial statements of the company, which are actually quite strong. They've been doing well. They have listed a profit for the past 3 years in a row. It talks about who's making what and all that good stuff, and which CEOs were allotted how much stock and stuff like that. Yeah, you better believe I checked to make sure the women were getting as much as the men. It was a little hard to tell in some ways, in the ways that it was reported, but I guess it looks kind of equal. And then they have a letter from our founders. So it says here, our life's work. Our compass. Number 1, physicians first. This mantra adorns our walls and is at the forefront of all of our product and business decisions. It is born out of our deep respect for healthcare's heroes and our conviction that patients are best served by empowering those on the front lines. Number 2, get stuff done. We're committed to improving the lives of our members. And number 3, find the win-wins. I think this should be their number 1, given that their business model is putting 2 groups in direct conflict with each other at the center of their business. They say, we have shunned easy revenue like banner ads. We look for the true win-wins, such as finding jobs, medical education, user-friendly telehealth, and clinical trial recruitment. We co-author and supervise our customers' marketing programs to maintain our clinical tone and rigor. Our promise is that if you are investing, we hope it's in part because you believe we can make real and meaningful differences in the everyday lives of physicians and patients. So there's that. We want to be the world's largest physician-owned technology company, and our IPO Reserve Share program is intended to both thank our members and kickstart that process. We feel fortunate to have the scale, growth, and profitability to meaningfully serve doctors and act on our vision at this exact exciting inflection point in healthcare. It's an inflection point in healthcare. So anywho, I'm not sure what they mean by physician-owned technology company, because there's 3 co-founders. Number 1, Nate Gross, MD. Number 2, Sherry Buck. And number 3, Jeff Tangany. So of those 3, only one of them is a physician. Of course, if physicians purchase the stock, technically we're shareholders and we own part of the company, but how much say you have is, all right? Now what's interesting is that even though those are the 3 founders, the only 2 who are still involved, so Nate Gross, MD, is not listed anywhere up in here on the list of people who are involved. So it says executive officers and directors. So Jeffrey Tangany is the chief executive officer and director. Anna Bryson is the chief financial officer, and Joseph Klein is the chief commercial officer. So none of them are physicians. Then you have non-employee directors, and some of these are physicians. These are people who are on the board of directors, and they kind of, I guess, influence decisions, but they are not actually employed by Doximity. And some of these are physicians. So you've got Gilbert Kleiman, MD, and he has been on the board of directors since 2011. He has experience in venture capital and business. And then you have Regina Benjamin, who just so happens to be the former Surgeon General. I mean, NBD, right? Scrolling down here, I'm like, and by the way, she was appointed by President Obama as the Surgeon General of the United States. They just slipped that one right in there. But again, she doesn't actually get paid by this company. So she's on the board. And then there's 2 other people who are business people who are on the board as well and not paid. So I don't know what happened to these other 2 founders, actually. So Sherry Buck and that other guy who was a doctor, I don't know what happened to them. But yeah, you've got a 2021 summary compensation table. So how much they made. The CEO's base salary was $240,000, and his option awards were $20 million. So his total compensation was $21 million. Anna Bryson, CFO, base salary was $221,000, and she got $4 million of option awards and $50,000 of kind of incentive plan compensation and something else. She ended up with $4.3 million. Yang Chao, the former CFO, after base salary, bonuses and everything, $3.2 million, and then Joseph Klein, the chief commercial officer, after all was said and done, $1.2 million. And these advisors that I said were not paid by the company, they get shares of Class B stock, so they get equities, but they don't actually get a salary from the company. So that's all listed in here too. After reading all of this, I do wonder how they're saying this is the largest physician-owned tech company in the world. I don't know, because I don't see any physicians owning anything on there other than the stockholders that they're trying to recruit, i.e. us. But the bottom line is, a company has to be prosperous and has to be making a certain amount of revenue and profit in order to even be considered to be listed on any stock exchange. Well, the New York Stock Exchange or the NASDAQ. Presumably this one will be listed on the NASDAQ because it is a tech stock. It's an app, so it's a tech stock. But that'll be determined, when the market makers announce all this. So right now that's all blank in the prospectus. Which exchange it's going to go on, and what's going to be the IPO price. So those are the two things we don't know yet. As of now, you can decide how much you want to invest. It can be up to $5,000, and then if you decide you want to do that, you give a deadline in the email. I think it might be Friday, I'm not sure. And you have to open an account with Fidelity, who is managing this actual investment, and then get it set up through them. So, bottom line, yeah, a company has to be pretty financially solid in order to consider going public. Given the financials that they provided here, I would say that they are. I think they have a lot of potential. Telemedicine is a trend. Just because we are getting over some of the severest hit from COVID does not mean that telemedicine won't go away. And it's really convenient for a lot of patients. So I think a lot of people might be incorporating telemedicine into their practices going forward. How much, I don't know. And who, I don't know. And will it be through this platform, or will it be one of their competitors? I don't know. But if you've ever used Doximity's telemed platform, you know it's really easy to use. And I think it's easy for patients, which is the number one thing. So I will say I do think they have a very nice telemedicine platform. I do feel a little hung up on the whole conundrum of we are the members and providing all of their content so that they can get paid to market stuff to us. But at the same time, I don't know. They're very transparent about it. It's a business. They exist to make money. The tech does help physicians and patients, like they say. It also connects us, for those of us who use it as a social networking platform, it does connect us and allow us to discuss articles and whatnot. So, it's not like some evil corporation that's trying to hide something. I don't think that at all. That said, though, I think it's a little bit of a stretch to be like, oh, we're doing this, out of the goodness of our hearts, we're offering you this 15%, of our shares going out to physicians because we, put our physicians first. Okay, sure. I don't know. I guess you do. I just have to believe you. Honestly, with what I've experienced in healthcare, I don't believe anyone who says they put physicians first because we don't have any power or money. So you have to follow the money trail. Who has the money? In this case, it's their customers, the big pharma, big healthcare. Something to keep in mind. So yeah, and at the end of the day, if you buy stock at an IPO price, most likely it's going to go up. Most likely you'll make a profit. No guarantee. It could tank. It could go to zero. Probably won't. And so you'll probably make a profit. You probably won't make that much because you probably can't buy that much stock because your investment is limited to $5,000. If your investment could be bigger, then I would say give it some serious consideration because you're going to have more skin in the game. But for 5G, if you can, or 5K, I don't know, 5G, $5,000, 5K, If you don't care if you lose it, then fine, invest. But it's not going to be like the most exciting investment you've ever made. If $5,000 is a lot to lose, do not invest in this. So yeah, it'll be interesting to see what it does. Anyway, all right, thanks for watching. If you enjoyed this video and you thought it was helpful, please subscribe to my channel, Money Med School. And yeah, stay tuned for more. Lots to come in the future. It's really great. All right, see you soon.